Starting in the 1980s, central banks were asked to control inflation to hit a specific target, often 2%. How they do so is surprisingly simple. In this video, I'll explain how central banks control inflation by first looking at how the average price is determined, second, looking at how money is created and destroyed, third, looking at how central banks use interest rates to control inflation, and finally, I'll explain what quantitative easing is and look at how it can be used in extreme circumstances. By the way, if this is your first time watching, I'm Seamus. I've spent the past decade working in Canada's public service after studying public policy and economics. I make videos to help you better understand how public policies are made and to understand what their impact really is. Let's get into this video. Before we get into the technical details, let me start with an easy story. Let's say there is an economy with one $10 bill. The only thing sold are 5 apples. If Jim uses the $10 bill to buy the 5 apples from Brenda, you can divide that $10 by 5 to get the price of apples as $2. Okay, so we took the total amount of money used and divided it by the number of goods sold to get the average price. Simple. Let's make it a bit more complicated. Let's now say that Jim still uses his $10 bill to buy the 5 apples from Brenda, but then Brenda uses that same $10 bill to buy 10 bananas from Jim. The amount of money is still 10, but it was spent twice. How many times the average dollar spent during a year is referred to as the velocity of money. So the total money used is actually the total amount of dollars, in this example 10, times the velocity of money, how many times it is used, in this example 2. So we have money spent of $20. Now we don't want to divide it by just the 5 apples this time, because there were also 10 bananas sold. So we can divide the $20 by 15 goods. The average price of goods in this example is $1.33. We can generalize this as the total money spent being the amount of money times the velocity of money divided by all the goods and services sold, or simply output, to give us the average price of goods and services in the economy. Now, this equation always holds by definition. So we have to look at ways to change money supply, velocity of money, or output from outside of this equation to change prices. Asking central banks to hit 2% inflation means that we want the average price of goods to go up by 2% each year. Now, if we think about the example we just walked through, if we consider year 1 the year where only apples are sold, and then year 2 the year where apples and bananas are sold, we're not really comparing apples to apples, pun fully intended. So rather than just looking at the total cost of the basket, the calculation of the consumer price index, which is the measure of inflation most often used by central banks, is the weighted average of the price change of all goods. It'll take the price increase or decrease of each good, weigh that by how much of it is bought to get the consumer price index. Now, the simplest way to achieve 2% inflation, if we think back to the equation we just established, is to have the same number of goods and services, or the same output, with 2% more money spent. Which brings us to the second part of this video, how money is actually created. And well, most of it isn't created by central banks. It's actually created by regular commercial banks. Sticking with Jim and Brenda, if Jim has the $10 bill and deposits it into his bank account, Jim still has $10. It's just in his checking account instead of his pocket. If the bank then gives Brenda a loan of $5, she now has $5. The world which only had $10 before now has Jim with $10, now in the bank, and Brenda with $5, so a total of $15. It was the act of giving a loan that led to the creation of money. If Brenda pays back her loan, then Brenda is back at $0, and Jim is at $10, for a total of $10 in this economy. So paying back a loan destroys the money that was created by the loan. Now, how do central banks control the amount of money supply if it's commercial banks that are the ones that create most of the money? Well, they do it through interest rates. And you don't need to get too complicated here. If interest rates rise, borrowing becomes more expensive, and so fewer people are going to take out loans, meaning less money is created, and more people are going to pay back any outstanding debt they have, and so more money is going to be destroyed. So raising interest rates leads to a lower supply of money. People also tend to hold on to their money more when interest rates are higher, so the velocity of money goes down too. Both of these going down means that there's less overall money spent, and therefore the average price falls. So central banks will raise interest rates to lower inflation. The opposite is if central banks want to raise the average price to raise inflation, they will lower interest rates to encourage more people to take out loans to create more money and discourage people from paying back their debt. In other words, discouraging them to destroy money. With more money floating around, it also raises the velocity of money. And so both the money supply and the velocity of money go up. Therefore, central banks will lower interest rates when they want to increase inflation. But interest rate changes also affect output, the denominator of the equation. Higher interest rates slow the economy, meaning that fewer goods and services are sold. This means in our equation, both the numerator, the total money spent, and the denominator, the total output or the total number of goods and services bought, fall. In practice, though, the effect on money spent is almost always larger than the effect on total output. So overall prices tend to fall when interest rates go up. Now, the complicated part of central banking is trying to figure out where to set interest rates today so that inflation will reach its target when the full effects of an interest rate change can take up to 2 years to move through the entire economy. So they're trying to figure out where the money supply, velocity of money, and total output will be in the future. People and businesses are also making decisions based on where they think interest rates and inflation will be in the future. So central banks have to account for those expectations. That's why central banks have a lot of very smart economists working for them. It may be simple, but it's far from easy. While it's the most prevalent policy tool, changing interest rates isn't the only option that central banks have to control inflation. In fact, central banks can only lower interest rates so far before things start to go a little wonky in the economy. Each central bank will determine what they call an effective lower bound that they are not willing to cross, usually just above, although some have gone just below zero. So what do they do when they reach that point, but they still need to raise inflation? Well, they don't look to commercial banks to create money anymore. They simply do it themselves. One option is to give it evenly to the population. So say $100 gets added to everyone's bank account. Or they could give it to governments directly to fund services or cut taxes. Those would both lead to ultimately higher prices and higher inflation. It's a practice known as seigniorage. In other contexts, you'll see it called an inflation tax, often in a negative sense, because it gives money to spend, but at the cost of higher inflation. But if your goal is higher inflation, then it's a good way to get it. The other option for what to do with the money that the central banks create is to buy stuff with it. In quantitative easing, the central bank buys bonds from investors. This does 4 things. First, turns their bonds into cash. So now they have more money. The money the bank created increases the money supply directly. Secondly, because a lot of owners of bonds are banks themselves, by giving them cash, it opens the door for them to create new loans. This can further increase money supply. Third, because the investors don't want to hold cash, they start purchasing other assets. Essentially, there are more investment dollars to chase the same amount of bonds. So interest rates go down for debt. With lower interest rates on debt, companies and governments spend more. More spending means a higher velocity of money. Finally, and perhaps most importantly, it signals to financial markets that the central bank is stepping in to push the economy through whatever difficult period it is going through. That lowers the level of risk people feel and makes them willing to start spending their money. Again, velocity of money is increased. So with both money supply and the velocity of money going up, we would hope to see prices going up too. However, quantitative easing is less certain than interest rate changes to lead to higher prices. And that's because the additional spending and investment that comes from quantitative easing also increases output. There is a much greater debate in modern economics about whether quantitative easing will truly lead to higher prices and therefore higher inflation. But the one effect of quantitative easing that economists are most certain about is that it raises asset prices. Of course, bond prices, but also stock and housing prices. There are many people who think that central banks should engage in seigniorage instead of quantitative easing. There are 2 main reasons for quantitative easing over other options. First, quantitative easing is seen as having a lower impact on politics. Adding $100 to everyone's bank account just before an election could impact how people vote. and central banks want to do anything they can to stay out of politics. Secondly, quantitative easing can be undone easier. Once the debt is repaid for the bond that the central bank holds, that money can then be destroyed. So it destroys the money that the central bank initially created. This is a process known as quantitative tightening. It wouldn't be very popular to give everyone $100 in their bank account one year and then take out $100 the next year. However, the downside of quantitative easing is that it raises asset prices, which disproportionately benefits wealthier households. So inequality is made worse by quantitative easing. So that's the trade-off, but especially since 2008, quantitative easing has won the debate at central banks. Let me know in the comments if you think they're making the right choice. So that's it. Central banks control how much people spend through the interest rate to impact the overall supply of money to control prices. As I said, simple, but not easy. If interest rates are so low, they reach the lowest point that the central bank is comfortable with, they'll create money themselves to either buy bonds, aka do quantitative easing, or give the money directly to people or governments, aka do seigniorage. So that's it from me today. If you enjoyed this video, please like and subscribe, and I will see you in the next one.